Lesson 4 to 6 Introduction to SPACs. Lesson 4 Target Company Identification and Due Diligence. Learn how SPACs identify and evaluate target companies for potential mergers or acquisitions. SPACs, Special Purpose Acquisition Companies, follow a systematic process to identify and evaluate target companies for potential mergers or acquisitions. The process involves extensive research, due diligence, and negotiations. Here's an overview of how SPACs identify and evaluate target companies, investment strategy and criteria. Before identifying specific target companies, the SPAC's management team establishes an investment strategy and criteria that guide their search. This includes determining the industry sectors, geographic focus, company size, and other parameters that align with the SPAC's objectives and investor expectations. Deal sourcing and network. The SPAC's management team actively sources potential target companies through various channels. They leverage their professional networks, industry contacts, investment banks, advisors, and proprietary research to identify potential candidates that meet the investment criteria. This may involve attending industry conferences, engaging in industry-specific research, and maintaining relationships with relevant stakeholders. Preliminary screening. Once potential target companies are identified, the SPAC's management team conducts preliminary screening and evaluation. They review publicly available information, such as financial statements, regulatory filings, news articles, and industry reports, to assess the company's financial health, growth prospects, competitive positioning, and overall fit with the SPAC's investment strategy. Due diligence. If a target company passes the initial screening, the SPAC's management team conducts detailed due diligence. This involves a comprehensive examination of the target company's financials, operations, legal and regulatory compliance, intellectual property, customer contracts, management team, and other critical aspects. Due diligence may also include on-site visits, interviews with key stakeholders, and consultations with external experts, such as legal, accounting, and industry specialists. Valuation and negotiation. Based on the findings from due diligence, the SPAC's management team evaluates the target company's valuation and engages in negotiations. Valuation considerations may include financial metrics, market comparables, growth potential, synergies, and other relevant factors. Negotiations involve discussions on deal terms, purchase price, transaction structure, and potential post-transaction arrangements. Letter of intent, LOI, or definitive agreement. If both parties agree on the proposed terms, a letter of intent, LOI, or a definitive merger or acquisition agreement is drafted. The LOI outlines the general terms and conditions of the potential transaction, while the definitive agreement provides a more detailed framework for the merger or acquisition, including specific terms, warranties, representations, and conditions to closing the transaction. Shareholder approval. Once the definitive agreement is reached, the SPAC seeks approval from its shareholders for the proposed merger or acquisition. Shareholders typically have to vote in favor of the transaction, and a majority approval is usually required. This step ensures that the shareholders have the opportunity to review and decide on the transaction before it proceeds. Closing the transaction. Following shareholder approval, the merger or acquisition transaction is closed. The SPAC and the target company combine, and the target company becomes publicly traded through the SPAC's existing stock listing. The transaction is finalized, and the post-merger integration process begins. It's important to note that the target identification and evaluation process can vary for each SPAC, depending on factors such as the industry focus, investment criteria, and available opportunities. Engaging experienced professionals, conducting thorough due diligence, and considering potential risks and synergies are critical steps in ensuring the success of the target identification and evaluation process. Understand the due diligence process and the criteria used to assess the target's suitability. The due diligence process is a crucial step in evaluating the suitability of a target company for a potential merger or acquisition by a SPAC, Special Purpose Acquisition Company. It involves thorough research, analysis, and verification of various aspects of the target company. Here's an overview of the due diligence process and the criteria used to assess the target's suitability. Financial due diligence. Financial due diligence focuses on analyzing the target company's financial statements, accounting practices, and financial health. This includes reviewing audited financial statements, balance sheets, income statements, cash flow statements, and related financial metrics. The aim is to assess the target company's profitability, revenue streams, historical financial performance, debt levels, working capital, and other key financial indicators. Operational due diligence. Operational due diligence assesses the operational aspects of the target company. It involves analyzing factors such as the company's production processes, supply chain management, distribution networks, key contracts, technological capabilities, intellectual property, and regulatory compliance. The goal is to evaluate the target company's operational efficiency, competitive advantages, potential risks, and growth prospects. Legal and regulatory due diligence. Legal and regulatory due diligence involves reviewing the target company's legal structure, contracts, litigation history, intellectual property rights, compliance with applicable laws and regulations, and any potential legal or regulatory risks. This includes assessing the company's corporate governance practices, licenses and permits, environmental impact, and any pending legal or regulatory issues. The purpose is to identify any legal or compliance-related risks that may impact the transaction or the future operations of the combined entity. Commercial due diligence. Commercial due diligence examines the market dynamics, industry trends, competitive landscape, and customer base of the target company. It involves analyzing market size, growth potential, customer segmentation, product or service differentiation, pricing strategies, and sales and marketing effectiveness. The objective is to assess the target company's market position, growth opportunities, competitive advantages, and potential synergies with the SPAC's investment strategy. Management team and human resources due diligence. Evaluating the target company's management team is essential. This includes assessing their expertise, track record, industry experience, and their ability to execute the business plan post-transaction. Human resources due diligence also involves reviewing employee contracts, compensation structures, organizational structure, employee satisfaction, and any potential HR-related issues, synergies and integration. As part of due diligence, the SPAC evaluates the potential synergies and integration requirements between the target company and the SPAC. This includes assessing how the combined entity can create value, realize cost savings, expand market reach, leverage complementary strengths, and integrate operations, systems, and cultures effectively. The criteria used to assess the target's suitability depend on the SPAC's investment strategy and specific objectives. This can include financial performance metrics, market potential, growth prospects, competitive positioning, scalability, regulatory compliance, industry-specific factors, and alignment with the SPAC's investment thesis and shareholder expectations. Conducting comprehensive due diligence helps the SPAC's management team make informed decisions, identify potential risks and opportunities, negotiate terms, and assess the overall viability and alignment of the target company with the SPAC's objectives. Discuss the challenges and considerations involved in selecting an appropriate target company. Selecting an appropriate target company for a potential merger or acquisition by a SPAC, special purpose acquisition company, involves several challenges and considerations. Here are some key factors to take into account. Alignment with investment strategy. The target company should align with the SPAC's investment strategy, industry focus, and investment criteria. The SPAC's management team needs to carefully evaluate whether the target company's business model, market positioning, growth prospects, and competitive advantages align with the SPAC's investment thesis and shareholder expectations. Financial performance and due diligence. Assessing the target company's financial performance and conducting thorough due diligence is crucial. The SPAC's management team needs to evaluate the target company's historical financials, revenue streams, profitability, cash flow, debt levels, working capital, and any potential financial risks. Challenges may arise if the target company has a complex financial structure, irregularities in financial reporting, or significant financial liabilities. Growth potential and synergies. The target company's growth potential and the synergies it can bring to the combined entity are important considerations. The SPAC's management team should evaluate the target company's market opportunities, competitive advantages, scalability, and ability to generate sustainable growth. Assessing the potential synergies, such as cost savings, revenue enhancement, expanded market reach, or technological advancements, is crucial in determining the long-term value creation for shareholders. market and competitive analysis. Understanding the target company's market dynamics and competitive landscape is essential. The SPAC's management team should assess the target company's market position, customer base, product or service differentiation, pricing strategies, and competitive threats. Analyzing the market trends, growth drivers, regulatory environment, and potential disruptors helps in evaluating the target company's ability to navigate industry challenges and maintain a competitive edge. Management team and culture. The management team of the target company plays a critical role in the post-merger or acquisition success. Evaluating the experience, expertise, track record, and cultural fit of the target company's management team is vital. Assessing whether the management team is capable of executing the business plan, driving growth, managing integration challenges, and aligning with the SPAC's objectives is crucial for a smooth transition and post-transaction success. Regulatory and legal considerations. Regulatory and legal compliance is a critical factor in target selection. The SPAC's management team needs to assess the target company's compliance with applicable laws. Licenses, permits, intellectual property rights, and potential legal or regulatory risks. Understanding any ongoing litigation, environmental liabilities, or compliance issues helps mitigate potential legal or regulatory challenges in the future. Shareholder approval. Obtaining shareholder approval for the proposed merger or acquisition is a significant consideration. The SPAC's management team needs to assess the likelihood of obtaining the required shareholder votes to proceed with the transaction. Challenges may arise if there are conflicting interests or dissenting shareholders who are not in favor of the proposed deal. Integration and execution risks. The integration process and execution of the post-transaction business plan present challenges that need to be carefully considered. The SPAC's management team should evaluate the complexities involved in integrating operations, systems, cultures, and human resources. Additionally, they need to assess the potential risks associated with the execution of the identified synergies and achieving the projected financial and operational targets. Selecting an appropriate target company requires a thorough assessment of various factors and diligent evaluation of potential risks and opportunities. The SPAC's management team should carefully navigate these challenges to identify a target company that aligns with their investment strategy, provides value to shareholders, and has the potential for sustainable growth and success. Lesson 5. SPAC Merger or Acquisition. Study the negotiation and execution of the merger or acquisition agreement between the SPAC and the target company. The negotiation and execution of the merger or acquisition agreement between a SPAC, Special Purpose Acquisition Company, and a target company involves several key steps and considerations. Here's an overview of the process. Letter of intent, LOI. Before proceeding to the definitive agreement, the SPAC and the target company often begin with a non-binding letter of intent, LOI. The LOI outlines the general terms and conditions of the proposed transaction, including the purchase price, structure, and key provisions. It serves as a basis for further negotiations and due diligence. Due diligence. Once the LOI is in place, the SPAC conducts detailed due diligence on the target company. This involves reviewing the target company's financials, operations, legal and regulatory compliance, contracts, intellectual property, human resources, and other relevant aspects. The purpose is to verify the accuracy of the information provided by the target company, assess potential risks, and identify any areas that may require further negotiation or clarification. Negotiation of definitive agreement. Based on the due diligence findings and discussions between the SPAC and the target company, the parties negotiate the definitive merger or acquisition agreement. The definitive agreement outlines the specific terms and conditions of the transaction, including the purchase price, payment structure, representations and warranties, closing conditions, and any post-transaction arrangements. Purchase price and consideration. Negotiating the purchase price is a key aspect of the agreement. The SPAC and the target company determine the valuation methodology, potential adjustments to the purchase price based on certain financial metrics or milestones, and the form of consideration, cash, stock, or a combination. Consideration also includes the treatment of existing equity holders of the target company, such as rollover equity or earn-out provisions, representations and warranties. The definitive agreement includes representations and warranties made by both parties. These statements provide assurances regarding the accuracy of the disclosed information, ownership of assets, compliance with laws, absence of material adverse changes, and other relevant matters. Negotiating these provisions involves ensuring appropriate disclosures, limiting liability, and addressing any potential risks or contingencies. Closing conditions. The agreement includes closing conditions that must be satisfied before the transaction can be completed. These conditions may include regulatory approvals, third-party consents, shareholder approvals, compliance with legal requirements, and the absence of any material adverse changes. Negotiating and finalizing these conditions helps ensure a smooth transition and protects the interests of both parties. Post-transaction arrangements. The definitive agreement may include provisions for post-transaction arrangements, such as transition services, employment agreements, non-compete clauses, and indemnification provisions. These provisions address matters related to the integration of operations, management transitions, protection of intellectual property, and allocation of liabilities. Approval and execution. Once the definitive agreement is negotiated, it requires approval from the board of directors and shareholders of both the SPAC and the target company. The agreement is typically signed by authorized representatives of each party, and the execution of the agreement finalizes the commitment to proceed with the transaction. It's important to note that negotiation and execution of the merger or acquisition agreement involve extensive legal, financial, and strategic considerations. Engaging experienced legal counsel and advisors is crucial to ensure that the agreement reflects the interests of both parties, addresses potential risks, and sets the foundation for a successful post-transaction integration. Analyze the valuation methods and pricing dynamics involved in the transaction. Valuation methods and pricing dynamics play a crucial role in determining the purchase price and terms of a merger or acquisition transaction between a SPAC, special purpose acquisition company, and a target company. Here's an analysis of the valuation methods and pricing dynamics involved. Valuation methods. Comparable company analysis. This method involves comparing the target company to similar publicly traded companies or recently completed transactions in the same industry. Key financial metrics such as price-to-earnings ratio, enterprise value-to-revenue ratio, and other relevant multiples are used to assess the target company's value relative to its peers. This approach provides a benchmark for valuation but requires careful consideration of the comparability and relevance of the selected companies or transactions. Discounted cash flow (DCF) analysis. DCF analysis estimates the present value of the target company's expected future cash flows. It involves projecting future cash flows, determining an appropriate discount rate, reflecting the risk profile of the investment, and discounting the cash flows back to their present value. DCF analysis provides an intrinsic value assessment based on the target company's expected financial performance and growth prospects. Asset-based valuation. This approach focuses on the value of the target company's tangible and intangible assets, such as property, plant, and equipment, intellectual property, brands, and contracts. The valuation is derived by assessing the fair market value of these assets, considering depreciation, market comparables, and potential synergies. Asset-based valuation may be particularly relevant for asset-intensive industries or when the target company's profitability is not the primary driver of value. Pricing dynamics. Negotiation. Pricing dynamics are influenced by the negotiation process between the SPAC and the target company. Both parties may have different expectations regarding the purchase price and deal structure. Negotiation involves considering factors such as growth prospects, market conditions, competitive landscape, synergies, and potential risks. Balancing the interests of both parties is essential to reach a mutually agreeable price. Market conditions. Market conditions can impact the pricing dynamics of the transaction. Factors such as overall market sentiment, industry trends, and the availability of capital can influence the pricing negotiations. During periods of favorable market conditions, sellers may seek higher valuations, while in less favorable conditions, buyers may have more negotiating power. Investor demand. Investor demand for the SPAC's units and the target company's industry or sector can affect pricing dynamics. Higher investor demand for the SPAC may increase the SPAC's market capitalization and provide more capital to fund the transaction, potentially affecting the purchase price. Likewise, the target company's growth potential and investor interest in the sector may influence the negotiation of a premium valuation, synergies, and value creation. The potential synergies and value creation resulting from the merger or acquisition are important pricing considerations. Synergies can arise from cost savings, revenue growth opportunities, market expansion, complementary capabilities, or operational efficiencies. Assessing these synergies and their financial impact helps determine the premium or discount applied to the valuation, dilution, and ownership structure. The impact on ownership structure and potential dilution of existing shareholders of the target company are considered in pricing dynamics. The negotiation may involve determining the ratio of cash and equity consideration, potential earnouts, and any rollover equity for existing shareholders. These factors affect the overall valuation and the distribution of ownership in the combined entity. Valuation methods and pricing dynamics require a careful balance between the target company's intrinsic value, market conditions, synergies, and the expectations and objectives of both the SPAC and the target company. Engaging financial advisors, conducting thorough due diligence, and considering a range of valuation perspectives can help navigate the complexities of determining a fair and mutually beneficial purchase price. Discuss the shareholder approval process and the rights of SPAC shareholders. The shareholder approval process is a crucial step in the lifecycle of a SPAC, special purpose acquisition company, and plays a significant role in protecting the rights and interests of shareholders. Here's an overview of the shareholder approval process and the rights of SPAC shareholders. Voting rights. SPAC shareholders typically have voting rights on significant matters, including the approval of a potential merger or acquisition transaction. The specific voting rights and thresholds required for approval are outlined in the SPAC's governing documents and are subject to applicable laws and regulations. Shareholder meetings. When a SPAC identifies a target company for a potential merger or acquisition, a shareholder meeting is typically held to seek approval for the transaction. The SPAC provides shareholders with necessary information, including a proxy statement or information circular, detailing the proposed transaction, terms, risks, and other relevant disclosures. Shareholders are given an opportunity to review the information and vote on the transaction at the shareholder meeting. Majority approval. In most cases, the approval of a majority of the SPAC's shareholders is required to proceed with the merger or acquisition transaction. This means that more than 50% of the voting shares need to be in favor of the transaction for it to be approved. However, specific thresholds may vary based on the SPAC's governing documents and applicable laws. Dissenting shareholder rights. Shareholders who are not in favor of the proposed transaction have certain rights, depending on the jurisdiction and governing documents. Dissenting shareholders may have the right to exercise appraisal rights, allowing them to have their shares purchased by the SPAC at a fair value determined through a legal process. These rights provide an exit option for shareholders who disagree with the transaction. Information rights. SPAC shareholders have the right to receive timely and accurate information about the SPAC and any potential transactions. This includes access to financial statements, disclosure documents, and any material information related to the transaction. Shareholders have the right to make informed decisions based on the information provided. Redemption rights. SPAC shareholders typically have the right to redeem their shares before the completion of the merger or acquisition. This allows shareholders to receive their pro rata portion of the funds held in the trust account, subject to the terms and conditions outlined in the SPAC's governing documents. Redemption rights provide an option for shareholders who may not wish to participate in the proposed transaction. Post-transaction shareholder rights. After the completion of the merger or acquisition, SPAC shareholders become shareholders of the combined entity. They retain their ownership rights and are entitled to any dividends or distributions declared by the company. Shareholders continue to have voting rights on matters affecting the combined entity and may participate in subsequent shareholder meetings. It's important to note that shareholder rights and the approval process may vary based on the jurisdiction, the specific terms outlined in the SPAC's governing documents, and applicable laws and regulations. SPACs are designed to protect the rights of shareholders and ensure transparency in the decision-making process, providing shareholders with the opportunity to participate in key decisions and exit options if they disagree with the proposed transaction. Lesson 6: Post-merger operations and shareholder redemption. Examine the post-merger integration process and the operational challenges faced by the combined entity. the post-merger integration process involves combining the operations, systems, cultures, and resources of the SPAC, Special Purpose Acquisition Company, and the target company to create a cohesive and successful combined entity. While every merger or acquisition has its unique circumstances, there are common operational challenges that the combined entity may face during the integration process. Here's an examination of some of these challenges. Cultural integration. Merging two companies often involves blending different organizational cultures, values, and ways of doing business. Misalignment of cultures can create resistance, communication gaps, and conflicts. Successfully integrating the cultures requires careful planning, effective communication, and efforts to bridge any cultural differences. It is crucial to establish a shared vision, values, and norms that enable employees from both entities to work together harmoniously. Organizational structure and leadership. Combining two organizations may require restructuring the organizational hierarchy, roles, and reporting lines. Determining the optimal structure and appointing leaders who can effectively manage the combined entity is essential. Challenges can arise in aligning responsibilities, decision-making processes, and clarifying reporting relationships. Effective change management and communication are crucial during this phase. Systems integration. Integrating IT systems, infrastructure, and data management can be complex. Consolidating and harmonizing systems, processes, and data from different entities is challenging. Compatibility issues, data migration, and system consolidation require careful planning, expert technical resources, and testing to ensure a smooth transition and minimal disruption to operations. Operational efficiency. Achieving operational efficiencies and synergies is a key objective of the post-merger integration process. Streamlining processes, eliminating duplications, optimizing resources, and capturing cost savings are common goals. However, realizing these efficiencies can be challenging due to differences in operating models, workflows, and systems. Integration teams need to identify areas for improvement, prioritize initiatives, and implement effective change management practices. Employee engagement and retention. Uncertainty during the integration process can lead to employee anxiety and potential talent attrition. Retaining key employees and maintaining employee engagement are critical for the combined entity's success. Communication, transparent leadership, recognizing and addressing employee concerns, and providing opportunities for career growth and development are important to mitigate these challenges. Customer and supplier relations. The integration process may disrupt customer and supplier relationships. Ensuring continuity of service, maintaining customer satisfaction, and preserving key supplier contracts are vital. Clear communication with customers and suppliers, addressing any concerns, and integrating sales and procurement processes effectively help in maintaining these relationships during the transition. Brand and market positioning. Consolidating brands and market positioning is a consideration in post-merger integration. Decisions need to be made regarding the use of the combined entity's name, branding strategy, and market messaging. Balancing brand equity, customer recognition, and aligning the new brand with the combined entity's strategic direction is essential. Regulatory and compliance considerations. Compliance with applicable laws and regulations is critical throughout the integration process. Understanding any regulatory implications resulting from the merger or acquisition, ensuring proper licenses and permits, and addressing compliance gaps are important considerations. Legal and compliance experts should be involved to navigate these challenges effectively. Successful post-merger integration requires careful planning, effective communication, strong leadership, and a focus on aligning the combined entity's operations, systems, cultures, and resources. Addressing these operational challenges ensures a smooth transition, maximizes value creation, and positions the combined entity for long-term success. Understand the rights of SPAC shareholders, including the option to redeem their shares or remain invested. SPAC, Special Purpose Acquisition Company, shareholders have certain rights that provide them with options regarding their investment. These rights include the ability to redeem their shares or remain invested in the company. Here's an overview of the rights of SPAC shareholders. Redemption rights. SPAC shareholders typically have the right to redeem their shares for a pro rata portion of the funds held in the trust account. The trust account is established during the SPAC's initial public offering, IPO, to hold the proceeds raised from the IPO until a merger or acquisition is completed. Shareholders have a specified redemption period during which they can choose to redeem their shares if they do not wish to participate in the proposed transaction. The redemption price is typically the original purchase price plus any interest earned on the funds held in the trust account. Vote on merger or acquisition. SPAC shareholders have the right to vote on the proposed merger or acquisition transaction. The shareholder vote is typically required to approve the transaction, and the specific voting thresholds are outlined in the SPAC's governing documents. Shareholders can assess the transaction details, proxy statements, information circulars, and other relevant information provided by the SPAC to make an informed decision. Remaining invested, shareholders also have the option to remain invested in the SPAC and participate in the potential upside of the combined entity post-merger. If the majority of shareholders vote in favor of the transaction, the SPAC completes the merger or acquisition, and the target company becomes a publicly traded entity. Shareholders who choose to remain invested become shareholders of the combined entity and continue to hold their shares. Post-merger trading. After the completion of the merger or acquisition, shareholders who decide to remain invested can continue trading their shares in the combined entity on the stock exchange or over-the-counter market. The value of their investment will be subject to market conditions, the performance of the combined entity, and other factors that affect the stock price. It's important to note that the specific rights of SPAC shareholders, including redemption terms and voting thresholds, may vary depending on the terms outlined in the SPAC's governing documents, regulatory requirements, and the jurisdiction in which the SPAC operates. These rights provide shareholders with flexibility and options to choose the best course of action based on their assessment of the proposed transaction, their investment objectives, and risk appetite. It's advisable for SPAC shareholders to carefully review the SPAC's offering documents, proxy statements, and any other relevant disclosures to fully understand their rights and make informed decisions regarding redemption or remaining invested. Seeking guidance from financial advisors or legal professionals can also be beneficial in evaluating the options available. Analyze the impact of shareholder redemption on the financial structure and ownership of the merged entity. Shareholder redemption in a SPAC, special purpose acquisition company, merger can have several impacts on the financial structure and ownership of the merged entity. Here's an analysis of the potential effects. Financial structure. Capital reduction. Shareholder redemption results in a reduction of the capital base of the SPAC. The funds redeemed are returned to the redeeming shareholders, decreasing the cash held by the SPAC. This reduction can impact the financial resources available for the merged entity's operations and growth initiatives. B. Cash flow and liquidity. The redemption of shares affects the cash flow and liquidity position of the merged entity. If a significant number of shareholders redeem their shares, it can reduce the available cash resources of the combined entity. This can impact its ability to fund ongoing operations, capital expenditures, debt repayment, or potential future acquisitions. C. Debt and equity ratios. Shareholder redemption may also affect the debt and equity ratios of the merged entity. If the redeemed shares were primarily funded through equity, the debt-to-equity ratio may increase, potentially impacting the company's leverage and creditworthiness. This can have implications for borrowing costs and access to capital markets. Ownership structure. Dilution of existing shareholders. Shareholder redemption can result in dilution of the ownership interests of the remaining shareholders. If a significant number of shareholders redeem their shares, the ownership percentage of those who choose to remain invested will increase. This dilution impact can be mitigated if the SPAC includes a private investment in public equity (PIPE) component to provide additional capital to the merged entity. B. Voting power concentration. The redemption of shares can also lead to a concentration of voting power among the remaining shareholders. With the redeemed shares no longer in circulation, the voting rights of the remaining shareholders become proportionately stronger. This concentration of voting power may impact corporate governance and decision-making processes within the merged entity. C. Impact on share price. The redemption of shares can potentially impact the share price of the merged entity. If a significant number of shareholders redeem their shares, it may signal to the market a lack of confidence in the transaction or the company's prospects. This sentiment can impact investor perception and potentially affect the share price in the short term. it's important to note that the impact of shareholder redemption on the financial structure and ownership of the merged entity will depend on several factors, including the number of shareholders redeeming their shares, the amount of redeemed shares relative to the total outstanding shares, the financial resources of the SPAC, and any accompanying PIPE transactions. The terms and conditions outlined in the SPAC's governing documents and regulatory requirements also play a role in determining the specific impact on the merged entity. The merged entity's management and stakeholders need to carefully evaluate the potential consequences of shareholder redemption and consider strategies to manage any resulting financial and ownership impacts. Engaging with financial advisors, conducting thorough financial modeling, and communicating effectively with shareholders are important steps in navigating these potential effects.